Hi, in this video we're going to talk about some non-numeric type questions that you might see. These are some questions that I've seen on the sample questions, and you might be asked some of these types of questions on, they're not numeric, but you might be asked, you might see some of these types of questions on your FM exam. So maybe like in a true-false type format. So the questions involve the Federal Reserve and key interest rates. And so let's talk about the Federal Reserve, or the Fed, first. So the U.S. Federal Reserve manages the banking system in the country, and it consists of three parts: a board of governors, and then there's 12 regional reserve banks known as district Federal Reserve Banks, and then there's a committee known as the Federal Open Markets Committee. So FOMC is the Federal Open Markets Committee, and that committee sets policy. That includes, among other things, it includes when to buy and sell U.S. Treasury bonds, and we'll talk about some more, some other things too in just a little bit. Now, again, the Fed manages the banking system, and each bank in the U.S. is required to have a certain amount of money called the bank's reserve on deposit at whatever its district Federal Reserve Bank is. So maybe if you have, I'm in Tallahassee, so the District Federal Reserve Office for Tallahassee, the bank is going to be in Atlanta. So every bank in Tallahassee is required to have a certain amount of money called the reserves, bank's reserves, on deposit at that Atlanta Federal Reserve Bank. Okay, so now let's look at some key interest rates for banks. So one is called the prime rate. So the prime rate is the interest rate that the banks in the U.S., when they lend to their customers. So if I go in and I ask for a loan, and if I'm one of their better customers, if my credit scores are good, then I may qualify for a loan at the prime rate. That's kind of the best rate for a loan for an individual to take out from a bank. Now, there's something called a discount rate. Remember, the banks are required to keep reserves at their Federal Reserve Bank branch. And so the discount rate is going to be the interest rate at which banks in the U.S. can borrow from the Federal Reserve to satisfy the bank's reserve requirement. You see, if the bank is lending out money, they might lend out more money to customers than so that what's left over might not be enough to have on deposit at the Federal Reserve Bank. And so they'll have to borrow some money from somewhere, and they can borrow money from the Federal Reserve. And if they do borrow the money from the Federal Reserve, then they're going to pay the discount rate. There's also a federal funds rate. This is the interest rate that banks can borrow, again, to satisfy their reserve requirement. So maybe the bank has lent out more money to its customers, than so that that's left over, they don't have enough for the reserve requirement. And so they're going to have to borrow the money from somewhere. And so if they borrow the money from the Federal Reserve, they pay the discount rate to the Federal Reserve, or they could borrow money from another bank, that bank, the other bank having enough money on hand, cash on hand, to satisfy its reserve requirement and then some. And so they take the and then some, and they can lend that to another bank that does not have enough money for its reserve requirement. And when they do that, then the federal funds rate is what is used. That's the interest rate that's going to be used, that one bank charges a different bank to borrow money to satisfy the reserve requirement. Now, let me make a comment here as a remark. The banks generally prefer to borrow from other banks. They don't really want to borrow from the Federal Reserve because that's kind of the last-ditch effort. So banks want to borrow from other banks first. And so they prefer to borrow from other banks because then that signals that they are a credit-worthy bank. So they would rather borrow money at the federal funds rate because that's borrowing money from another bank than to borrow money at the discount rate because that's borrowing money from the Federal Reserve. And again, the idea is that they don't have enough money to satisfy the reserve requirement because they've lent out, they've lent their money to customers. They've lent the cash that they have. They lent that to customers, and the amount that they have on hand is not enough to satisfy the reserve requirement. Okay, now there's something called a federal funds target rate. This is another thing that the FOMC, the Federal Open Markets Commission, is charged with, is to set what that target interest rate is for the federal funds rate. So that's called the federal funds target rates, the target interest rate for the federal funds rate. So a little remark here is that if the federal funds, I'll read through this paragraph with you, if the federal funds target rate is increased, then it makes it more expensive for banks to borrow money to cover the shortfall in the reserve requirement. So if the federal funds target rate is increased, you're going to make it more expensive for this bank to borrow money from another bank to satisfy the reserve requirement. And so what that's going to do is that's going to make the banks not want to lend as much money. And so in turn, banks will write fewer loans because they don't want it to be expensive to, if it's too expensive to borrow money from another bank to satisfy the reserve requirement, then they just won't lend the money that they have. On the other hand, if federal funds target rate is decreased, then banks are more inclined to borrow money to cover a shortfall in the reserve requirement, and so then they'll write more loans. And so by changing the federal funds target rate, the Federal Open Markets Commission can affect what the lending policy will be. Okay, and then finally, another key interest rate is that you'll see from time to time in questions is the LIBOR rate. LIBOR stands for the London Interbank Offered Rate, and all that you need to know about this rate with respect to the FM exam is that this is just a benchmark. It's an often used international benchmark interest rate that banks in London use to charge other banks. But you might see it in the context of a problem. The problem might say, well, the interest rate is going to be LIBOR plus 1%. And then later on, they'll tell you what the LIBOR rate is, and you just add 1% to it to do your calculations. Okay, so that does it for the Federal Reserve and the key interest rates. Again, these are types of problems you might see in a true-false format, or determine which of these statements is true type question. Not very many numeric questions. With respect to the LIBOR rate, sometimes you see questions that are numeric questions. And again, I mentioned this a little while ago. They might say, well, the interest rate that you use in this context will be LIBOR plus 1%. So you just follow the directions. All right, well, that does it for the course. I hope that you've enjoyed it, and good luck studying on the exam. I'm confident that if you'll master the topics that we've covered in these videos, you're going to do very well on the FM exam. I hope that you've enjoyed the course as much as I've enjoyed it, and good luck on your studies.